We start today's talk by talking technicals. It's where we dig into the numbers and the charts and more. And somebody who gives us the numbers, the charts, and more, Michelle Schneider. She is chief strategist at marketgauge.com. So just like it sounds, marketgauge.com. Miss Schneider, it's great to have you back on Money Life.
It's February, but can I still say Happy New Year, Chuck?
Well, you can because we haven't seen each other this year. But at this point, given this market, and maybe not the technicals, but some of the things that are happening around it, if you say Happy New Year, the question has to be like, is it from a market perspective? Is this what Happy New Year feels like?
For me, absolutely. First of all, my teeth were cut on the commodities exchange when commodities were hot, right? So I love volatility. And I love having a plan in my head that really basically encompasses what to do in case of volatility. And that's, I've been saying this year, is so important that people, and this is perfect for our segment, at least have some understanding of a chart, price action, and that price will dictate the narrative this year. And so far, that's true. And so just for example, the hysteria over the weekend about the tariffs was such a great buy opportunity if you knew where to look this morning on the open, because we also know that we're in an administration that tends to be very hyperbolic in terms of the demands that are made only to create some place of negotiation. And it's an interesting tactic, and I certainly don't want to get political, but so far today proved that it worked.
Well, yes, we are recording this on Monday as we're getting towards midday. The market opened very sharply down. But let's talk about that from a technical standpoint as well, because here we are 4 weeks into the year. We've just gotten through January, so 4 or 5 weeks into the year, technically, wherever you want to be. But on two of those weekends,
right?
Two of them, because we had the DeepSeek stuff come out over the weekend and then lead into a rough Monday. Now we had the tariff stuff come out. As an investor who's looking for volatility and likes volatility, but who normally gets to take the weekends off, are we changing the weekends for technical traders now?
Well, last night I was on my Coinbase wallet trading cryptocurrencies when they had this incredible crash. I bought the dip. Of course, I had an idea of where the risk is. And of course, the second part of the volatility is to have an idea going in that you're buying against the support level, that if it breaks, you're going to get out. Don't get married into buying a falling knife. But this has been the fade trade, right? And if the weekend sets that up, now I'm not going to be trading anything like currencies or indices or even individual stocks overnight. But the crypto is kind of fun. It's like the new commodity. It's so technical. So yeah, I think the weekends, two lessons we've learned is, number one, try to not get hysterical over the news that comes out, even if you're going to see a major dip. And number two is, if you're going to take advantage of that because it's hitting a support level, and we can have lots of examples of that just for Monday, at least know and put in an immediate stop on Monday so that in case the opposite happens, it's not buy the dip, but instead, oh my God, this is just the start of the crash. At least you're protected from a risk management level. And and that's the world of a trader, not an investor, a trader. So yeah, I'm happy to answer your original question.
Okay. We're off to a good new year for you as a trader, but as an investor and as somebody who is looking at support and resistance, where are we now? Are we closer to the next leg up, or are we closer to the next breather?
Well, now there's a couple of things to know about this year from a technical standpoint. Number one is that this is a year that ends in the number 5. And if you go back from the 1880s until now, only one mid-decade year ending in 5 was a negative year. Interesting, right? And actually, this is something that Hirsch, I can't remember, but not Jeffrey.
Yale Hirsch, Jeffrey's father.
Yeah, exactly. Jeffrey's dad. And Jeffrey and I are good friends.
Me too.
Yeah, he's a great guy. He's the one who wrote about this. So that's number one. Number two, interestingly enough, this is what the year of the Yin Wood snake. Now, to most people, that sounds, why would she even bring up Chinese astrology? But the truth of the matter is, number one, 1.7 billion people follow it. Number two is there's a saying that says millionaires hate astrology, billionaires love it, right? There's something to it. And since we just started the year of the snake, it's the last time we had the Yinwood snake was 65, right? And in 1965, the year started out so similarly, where we went up in January, we had a brief sell-off in February, the market sort of peaked out in May, had about a 10 or 11% correction then, and wound up the year 10.8% by the end of the year. The interesting thing, though, is that in February 66, it was the last time we saw the Dow at 1,000. That's how long ago we're talking here. Until, if you adjust by inflation, 1995, 30 years where the market really did nothing. It just ranged. Could we have that? Possible. But we don't have to worry about that now, right, Chuck? All we're looking at is 2025. We're starting similarly. Lyndon Johnson he had tariffs going 25% on certain goods, particularly from the European Union on cars. He was really pissed off when the Fed raised the rates, but they did, and he relented finally, and it was okay. Of course, it wound up not controlling inflation. So if we go to 2025, we're almost parallel, right? You know, Trump doesn't want the rates to be raised, but now he's saying, all right, fine, the Fed paused, good. And the tariffs, he's not going to, obviously what we're seeing today, go to the lengths that he's threatening because he knows these countries are going to negotiate with us. You know, we're still a very powerful nation. That's kind of the fundamentals. If we look at the technicals, what happened today, let's just use the S&P 500, for example. So it came in, gapped under the 50-day moving average, and now midday it's scraping it again. So all you have to say is, if you bought the opportunity in the morning, as soon as you saw the headline that Mexico was going to capitulate for a little bit, send troops against the drugs, and also Trump would not do the tariffs for another month, you buy that. And you look at that 50-day moving average. If we close above, you stick. If we don't close above, you probably want to at least lighten up. If you're investing, this is hard because most investors are passive investors, and they're going to have to sit through the volatility and decide which themes they think could emerge. So I don't want to keep talking, but I will say one more thing, and then we can go from there. What are the themes that are going to emerge this year is what investors have to ask themselves.
Well, but we also know what themes are not going to emerge this year. We're not going to see significant rate cuts, and that drove things last year. Now, I recognize that technicals can drive the market higher. However, if you want it to be long-term and stick, you're looking for earnings to drive it. So how sensitive has this market been to what's been going on with earnings, and how likely do you think that earnings will keep the trend of 2 big years, at least going with something that's at least moderate for this year?
Well, I would expect that if we're looking at the Mag 7, we're already seeing that, you know, we had such stretched PE ratios that in terms of the growth, are they going to go away? No. But do they have a lot more upside from these levels? I would also say no. But what it is good news is that we're seeing a lot of the stocks, particularly ones that have more of an American focus, made in the USA, doing really well and reporting maybe not as strong, but they have potential growth. In terms of the earnings, you want to really focus on those calls that say we see a good growth in 2025, as opposed to what we heard from Jensen Huang, which is, you know, maybe potential growth is not that great right now. You know, the capex, as they're calling it, isn't necessarily as strong as it's been. So, you know, that's how you have to look at it. People have been looking for a broadening of the rally into other areas. And so far, if you're smart, that's what's happening right now. So this is going back to the theme base. And in terms of interest rates, I wouldn't worry about that, because go back to 65. They raised the rates and inflation was at 1.9%. By next year, it was 5.9%. By the 70s, we know it went out of control. So it's not going to control inflation necessarily.
All of this put in, you love the volatility, you like what it's doing, but is there anything that scares you? Like, we've had headline risk. For you, are you looking at everyone and just kind of licking your chops going, oh, another opportunity? Or is there one out there that makes you more nervous than the rest?
If this tariff information wasn't the lesson that one should not necessarily be overly scared right now, then I can't imagine what could come out that could really be scary. Maybe, if things really exploded in the Middle East over oil prices and inflation became something so frightening. And I do believe that, by the way, inflation is going to pick itself up. It already has, looking at food prices. For one, looking at gold, looking at silver, looking at the miners. You want to talk about technicals. People have been fighting the technical obvious charts in gold, in silver, in miners, in wheat, in corn, in DBA, if you want to look at that. Even in oil, people have been saying, oh, the commodities can't go up. Don't ignore those charts. Those are going to be double tops. And I'm like, no. If you look at a gold chart, it just keeps laddering up to new levels. And now it's on new all-time highs. That's what I'm talking about. I'm talking about that at what point can you make money in commodities, and at what point is that going to impact equities? We don't know that. That may be the defining moment, but I'm not too worried about, because we know both of those things can go up at the same time. And right now we're still experiencing economic growth in this country. So stagflation is on the table, but it's not here yet.
Well, we will be watching to see how it plays out. Meanwhile, Mish, this is great. Thanks so much for joining me on the show. We'll talk to you again as we see it play out.
Thank you so much.
That's Michelle Schneider, Mish Schneider. She is the chief strategist at marketgauge.com. You want to see all the things they're doing, which will help you whether you're a trader or you're an investor. Go to marketgauge, just like it sounds, marketgauge.com.